Thank you very much, Jerry, and thank you very much for having me back here again. It is nice to return and have a chat about what we are thinking and where we think the risks. In fact, I do like talking about oil and gas. I find it one of the more interesting things to do because the industry is so dynamic, and it's one of the things that keeps people, forecasters, analysts like me, very, very honest because it is so dynamic. And I have to be honest, it was one of the reasons why I used to get into endless debates and arguments with people about the whole concept of peak oil. Being an economist, I would always argue supply not meeting demand is an impossibility. Prices will adjust, things will be found, and demand will change. Supply and demand always meet. The balancing item will be price. So we've seen that, we've gone through the different motives, and now we've seen the end result of what high prices give. A dynamic industry which is now very responsive to prices, and as such, we live in a new, different world, and one where we, to some extent, as an analyst, I park OPEC to the side. So, last year we talked about the global sort of trends and how they're very disinflationary. That story is still very much there. Central banks at that point in time were putting a lot of liquidity in the system. The US has started removing it, and we've seen low interest rates start to drift a little higher across the globe since then. Love talking about how the low prices we've seen of late have spurred on demand. It's continuing, but that demand is changing, and I wanted to talk about some of that. We had been talking about gas prices continuing to fall. Basically, we had a more sort of disinflationary, slower growth profile than what came through in reality. And as such, we underestimated oil prices. I have to be honest, we didn't expect OPEC to achieve quite what they did, nor did we expect demand to be quite as strong as what it did. So we underestimated prices probably about $10 for this year. And that's what the forecasts were for last year. We were sitting this time of the year, we were thinking that somewhere around September this year now would be around the 40s, the low 40s, $40. And of course, we all know it's stronger. So that's the backdrop, what we're going to be doing today, talking about that stronger growth that we've been seeing. How long can it last? Is it going to be continuing through 18 and 19? We think at this point in time it's probably about as good as it gets, but we're not talking about a massive slowdown. The US recovery remains on track. Part of the story is going to be further rate hikes from the US. We'll put that in the backdrop. But if you are like us and believe in further US rate hikes while nothing coming from anywhere else, and that stronger growth being reflected in the US, that does mean a higher US dollar than we're talking about now. I have to admit we're surprised at the current weakness of the US dollar, and we'll have a bit of a chat about that. But overall, we are looking for the reverse of that. Crude oil demand will be relatively robust. OPEC will work hard, but we don't see it doing a lot more than what it's doing now. And in the end, it's the US and their supply of fracked oil, which is going to set the price. Basically, now it's the cost curve. So in the big picture backdrop, we do have, this is like just a little quick chart highlighting the momentum we're seeing. It's the global PMIs, business surveys, or we put together one of trade, looking at import-export orders. Whichever way you slice it, businesses around the world are far more upbeat than people anticipated. This is not just the US story, it's a European story, it's a Japanese story, and even a Chinese story. And the trade numbers have been reflecting that. As you see, we're sort of at the really sort of top end of a normal range. So we've had the big surge in growth, the big surge in demand. I'm back and gone.
Plan B.
Plan B? Maybe we need Plan C. So we've got this big, strong demand growth coming through right now, and that is the strong backdrop. And that's one of the reasons we can talk about upside risk. So for any forecast you see from ourselves, at least between now and the end of the year, there is more upside risk to our forecast than down, quite clearly. The US is on a very, very strong path. Pre the election of the Trump administration, it was healing, it was getting better. We've seen the unemployment rate come down dramatically. More importantly, in this number, the chart's been reversed to make a match, but the employment to population ratio has been improving, going up. It comes down in this chart, but that is a strengthening sign. More people as a share of the population are working. So it's not just people leaving the workforce as it was in the past, but an underlying strength and growth. You've seen that coming through in incomes growth. Modest because wages growth is modest, but it is picked up a little in the US. It has been supporting a recovery in housing, It's been reporting a covering in the sort of domestic demand, but you haven't seen that flow onto stronger investment, nor into very, very strong employment numbers. It's just sort of more modest. So the recovery's there in the US. Donald Trump gave us a bit of a inflation trade early in his election time, early this year. We cautioned about how that inflation trade could last and how strong it could be. There's a lot more rhetoric than reality. And since then, we've actually seen the opposite and now a fear around what's happening in the US. We also say be careful there. One of the things that we've sort of seen of late that makes you think about being cautious about how negative to get in the US. One, the Trump administration has shown its true colours and is willing to cross the floor to negotiate, as it did with the debt ceiling. And two, the US founding fathers created a very complex structure of President, Congress, judiciary. All three have a lot of power, all three are independent, all three never agree, means things happen slowly. It's a very, very sort of stable system in some ways, so don't expect big changes. The good thing too that's been happening is Europe. That's been becoming far more positive. This chart highlights Spain and Italy together there, but I don't think you'd be surprised for me to tell you it's mostly Spain. So the story of the recovery we're seeing in Europe right now is a German-Spanish story. Germany exporting, Spain because they basically hit their economy hard post-GFC, and it's now in the recovery phase. Italy never did that. So we've got this growth that's underlying it that's more positive, but as you can see, we think this year again is about as good as it gets. Without further weakness in the euro, you won't get a lot more growth than what we're getting out of Germany, and Spain's running out of that free kick coming back from the recession they had. So it's a positive story, but one that's slowly growing, i.e. the central banks in Europe will not be taking away liquidity like the US is. That's it, a weaker euro, stronger US dollar story. Also keeps liquidity in the global system. China is actually a fascinating story which I wish I had more time to talk about, but to give it a real little nutshell, what we're focusing on now is the fact that we've seen the 5-year Congress coming up. Xi is consolidating his power. He's getting in more of a position that we've never seen one person dictate since we have Mao. That consolidation of power means he's really consolidating the structure that they want to see, i.e. don't expect a big bang reform post the Congress. The focus now is still very much around developing a military-industrial geographic hegemony in through Asia, consolidating their position in the world, i.e. more of the same with some trimming around the edges to try and prevent disruption. So growth just slows down modestly rather than has a big collapse. Also expect, you hear a lot about the banking crisis in China. A lot of that will be isolated if it does occur, which we have question marks, around government banks lending to government companies, so it's internalized. There is a lot of the what they call the shadow banking that people see risks about, predominantly held by a small share of wealthy individuals within China, who the administration has made pretty clear they're happy to burn if things go pear-shaped. So the problem's going to be very much consolidated around the upper end of China rather than the broader base, i.e. some shocks, some uncertainties, but not necessarily a destabilising massive financial crisis. I'll skip through our forecast and really we'll talk about why crude oil is fundamentally positive for the medium term, but why we keep this sort of bearish backdrop. And really, it's about the US and fracking and just how much better they're getting. Always surprised me that, when the US oil industry started expanding, that people just didn't think about what would it mean. To find oil in reserves on par with Saudi Arabia inside the US is so different to finding it anywhere else. You're finding it in the world's deepest capital market, the best infrastructure for distribution, the technology goes back a long way, and skill base of the workforce is all there. It's the best place in the world to have an oil industry. Also in the backdrop, don't forget, lower prices has meant we can continue to see growth in automobile driving. It has picked up. For a long time it flattened out with high prices, low prices, the Americans respond and drive. Now, this is a very short run story. I'll give you a little quick before I finish why We don't want to take the story too far. But definitely for the next near term, it's a very positive story. I do watch the inventories in the US, but I do give a big, huge caveat. That big decline we've seen lately of US oil inventories, not incoincidentally, we've seen a big decline in Saudi imports into the US. The Saudis very quite astutely are deciding to hold back on their import into the US and selling it elsewhere. It's creating a much more drop in the very visible inventories, and it's getting people excited about the underlying strength of demand. I caution that. Levels are still reasonably high, and it's been driven by a supply shock only unique to the US in terms of imports. If you look at floating storage worldwide, it's still volatile, but at a relatively high level. Corrected it a little, but it shows there's still quite a bit of oil out there. So I don't quite believe the supply balance story. Of course, the non-OPEC's driving it, and this is what the US growth outlook, which is a general trend. The one thing I'll say about the numbers being put together by EEI or IAA is it's all based around current technology and current cost curves, and we know they're constantly improving. So I'm very cautious about saying that at best the US should see growth of 1.5 million barrels per day this year. There's, I would argue, upside. Even at the moment, though, it's running a little behind. We have had some disruptions going through there, as you would be well aware. I would just sort of, US crude production point out this productivity story is quite significant. We've seen the small lift in drilling rigs and output in the US go back to almost pre-crisis levels or pre-collapse levels. Output per rig is multiplying, is really expanded. So the technology's there, it's improving, and it's driving down these cost curves. And you sort of see now that we're in that basin where these guys are now setting the price. And if the average cost is somewhere around $45, $46 a barrel, that's where it settles. As you can see, there are some really good reserves that are at $30 a barrel, and there are some higher ones at 70. That's a global sort of trend, but that 45 barrel to us is setting the benchmark. And I have to argue that we believe it's going to, with technology, keep coming down. So that gives us a sort of more balanced story. We do have our forecasts of near-term weakness and then some strength. The strength is on the backdrop that you don't keep seeing those big improvements in productivity, so there's a risk to that. And we see stronger growth further out and the return of normal cost inflation. So that gets us back to the $60 a barrel sort of mark, more longer term. And of course, lagging behind will be the gas prices. Now, I'd like to say that's kind of the end of the story, but there are a couple of risks associated with this. A positive risk is if we're right for the near term, does mean rates on hold in Australia is our view, stronger US dollar, weaker commodity prices. Aussie has got lots of downside risk rather than upside. It's being dragged higher at the moment by lower yields around the world, fears about the US dollar and a weak US dollar story, all giving us this boost. It's taking us to the top level of what you'd think is normal range. It can trade 7 cents either side of that normal range. So we're at the top end now. The bottom end of that is getting towards 70, and we think even lower going forward. So in the backdrop, lower Aussie forecast. In our forecast going forward for commodities, we do have this weakness coming through. I should also go back and highlight that the RBA remaining on hold in a world of rising rates. If you're thinking about business costs, I could be very comfortably sit here and say, RBA is not going to raise rates for the next 2 years. However, with the US raising rates and bond yields going up, bank costs of funds through the bond market is going up. Bank costs of funds generally, as you would be hearing, are going up. I mean, I know I work for a bank, but underlying that is some truth that there is a general push to raise costs that we're seeing. That means Australian market rates have got upside, not downside. So within this environment, RBA remaining on hold does not mean the mortgage rates we're paying, nor the business rates are going to remain static. They've got more upside than down. Now, I've left a little bit at the back because I do want to leave with a thought. We've got this environment where we've seen this tradition of stronger growth leading to stronger oil consumption. We've seen these lower prices stimulate growth in demand, particularly in the US, and seen a recovery in the Western world for oil consumption that we haven't seen for a while. I would, however, given the press we've seen of late, really like to raise something that I like to watch closely and think about its broader implications, and that is, of course, electric vehicles. They are coming. You've seen what's happened in Europe with London and Paris starting to ban vehicles. This week, we had China. Now, the reason I mention this is China, if China goes the way the world is shaping now, the shape of whatever China starts thinking about as its dominant form of any technology or consumption item will dictate what we do. Electric vehicles are going to be revolutionary, not just in terms of what the energy they use, but also in terms of the commodities used to manufacture them, the number of people taken to actually manufacture them. They actually take a lot less, they're much simpler products, and the number of people needed to service them. They have much lower service requirements, and you need a very, very different technical base. Now, I won't claim it's like going from the horse and cart to the automobile, but we're seeing a smaller quantum shift in which is going to have massive implications for our cities, employment, and consumption. And the reason I'm highlighting China is, for the last 100 years, it's been those on the right-hand side, the North Americans, the Europeans, who, with their middle class, have defined the consumption goods we use, the products we produce. By 2030, it's going to be Asia, with their huge market. Whatever they determine will become the predominant form of transport, will become the dominant form of communications we use. It will dominate everything, just by the pure size. So if they are seriously going electric, and if that's their strategy, whatever way they do it, whether it's electric plug-ins, electric hybrids, electric hydrogen, it will define the type of cars we get as well. So watch that closely. And that also does mean we now have a break. Economic growth in China may not drive the same amount of growth in oil consumption that it has in the past. So it's definitely something to watch this space. And it's one which can blow up my forecast further out about oil prices. Now, that is where we sort of leave it. I do leave it with a very positive near-term story, one of where demand is stronger than we thought. We do think it's slowing next year, but between now and the end of the year, there's a lot more upside. OPEC will try its best. You do have people forecasting much more robust numbers in oil prices than what I am, or what we are. I would make one caveat on those numbers. A lot of those houses are also involved with the IPO coming up for the Saudis. I'll just make that observation. I'm not going to say anything else. So OPEC will do their best, but we don't think they can meet it, and the US is going to be the defining moment. If US production is not as great as we think it is, prices will go up. If US production is better, of course they'll go down. Do watch the EV market. How fast it develops is going to have a big impact on how fast economies evolve away from oil and energy and what new energy mix they have. Do watch out for a near-term rally. We're not so bullish, but there is lots more upside. We have got a falling Aussie, but again, near-term, more upside than not. I will also have to, as always, put in my personal disclaimer. I do have a challenge. If someone can actually tell me which country's at the bottom paragraph, I might even buy them a bottle of wine. It's an awesome disclaimer that's really about trying to cover us for working in so many different markets. But what I'd like to do is, rather than do that, is actually just highlight again that I'm really trying my hardest to present an argument, a scenario, a structure to help you think about risks. We do firmly believe that most near-term risks lie to the upside for prices and to the downside in the more medium term. But at the end of the day, if I walk out of here, if someone comes up to me and says, "Good presentation, Justin, but I disagree with you for these reasons," I'm a happy man. I actually feel I've done my job, rather than just someone saying, "Good presentation, I agree with you 100%, and just doing it from that point of view. So, thank you very much.